Welcome to the Breakfast Leadership Show, where we interview global thought leaders on business, leadership, and life. Here's your host, keynote speaker, best-selling author, and chief burnout officer of the Breakfast Leadership Network, Michael Levitt.
Welcome back. I've got Shinobu Hindert on the line. Shinobu, how are you?
I'm doing great. Happy to be here.
I'm glad you're here. And we talked a little bit in the pre-show about investing. And so why don't you share a little bit about you and the work you do?
Yeah, so I have a financial education company that focuses on educating people around how to get invested and really build long-term wealth. Prior to this company, I was a financial planner for a very big company and had a client base of about $350 million under management, and then really transitioned to the educational part of it because I was really surprised at, outside of my client base, how many people really didn't have the tools or the resources to become more invested in the markets. And as much as I enjoyed helping people that had already built that wealth, it just seemed more attuned with my demographic and my age group to get out there and really start shaking things up and getting people excited about it. So I am a certified financial planner. I've been in the financial industry for about 15 years. So this is truly my passion.
That's awesome. And I agree with you. There's a lot of people that are just, completely unaware of what investing is. They have a general idea. Maybe through their employer, they have a 401k. So they have that blank stare when they get the paper and they're trying to figure out, okay, how do I divvy up, my funds? What do I want to invest? And, the questions are really vague, going, okay, are you conservative or more aggressive in your things? What types of, commodities? And they're deer in headlights, glazed over, because there really hasn't been any education on things in a long time. I remember being in school, we actually in a business, I think it was a business math class of all things. We had a couple-week assignment where we had to pull out the newspaper back when all the stocks, or at least the Dow Jones stocks, were listed in the newspaper, and we had to track, our particular stocks that we had picked out for a week. And I remember that because he had to, and this was even, really date myself, highlighters weren't out yet. We had to use either a pen or a circle or something like that. All the modern tools today that I didn't have as a kid. But I remember looking at that. And of course now, you don't have, any type of stock information in a newspaper, at least your normal, local newspaper, much less even the Wall Street Journal. It's like you can look things up online, but you're not going to see, pages and pages of all the stocks, which I'm sure makes the print house really happy, because that must have been a complete pain to update every one of those numbers. I can't even think about that. But what we're seeing now, especially with the Robinhoods and all types of other things, is we're starting to get a lot more people at least exposed to it. Mm-hmm. And they're hearing things and they're going, okay, what about this? And, you have Elon Musk talking about certain types of cryptocurrencies and tweeting about things like that. So there's a lot of dialogue about it, which is good because it's at least informing some people, okay, there's things out there. But digging in deeper, what are some of the common things that you see in working with people that aren't comfortable with investing? What are some of the roadblocks that they put up?
I think there's so many internal roadblocks that we put in place. There's roadblocks existing in the industry. So I'll go ahead and date myself, but 15 years ago, you couldn't go to a big financial firm with a little bit of money and say, I want to open an account and I don't want to pay any fees. That just didn't happen. Every time someone opened an account, there were minimums, there were investment minimums they had to meet, there was annual account maintenance fees. Anytime they wanted to do a trade or anything, they're paying and paying and paying. So there was this actual roadblock that you needed to have a lot of money to get invested. And that's not the case anymore. Because of technology, because of this innovation, investing is becoming democratized. So everyone does have access to it now. So just to put that out there, that those external roadblocks that used to exist don't exist anymore. Then a lot of times people will go and look at a company and say, well, I don't really identify with this older man who's talking to me in a suit about investing. So that's a turnoff. And people feel like, well, they don't really understand me, or I don't fit in here. So there's these external roadblocks, but they really don't exist anymore. So a lot of it's coming from the internal, because we're told things about money growing up that we don't even necessarily identify that we're writing our story that way, right? My father was extremely conservative with money. He was born and raised in Kenya and Africa, lost his parents before the age of 18. He had to become financially dependent very quickly. So as I was growing up, he was always afraid that he would die and leave me with nothing. So his message to me was like, you need to learn how to take care of yourself. You need to make sure that you have saved money. And so I began to hoard money as a child. If I got $5 for chores and my first jobs that I had, I would hide money in cash in these envelopes in my room. And that's a kid doing that. So as I got older, even though I was excited about this industry, I still had these tendencies that were internal. So I think that you just need to look at what is the story you're telling yourself about money, and just take it a little step farther, because you can now, even if you had $15 and you wanted to go open a brokerage account where you're trading, you can. And the minimums on the funds, or even these fractional shares they have on stocks, you can do it. So I think it's identifying, like, finish the statement. I don't feel comfortable investing because, and just jot it down and start to work through those things. Because once you identify what's an internal roadblock, what's an external roadblock, you can just take one step in the right direction, and then you gain confidence after you take that step, and then you kind of keep going down that way. But the industry has become very friendly to really anybody who wants to start investing.
It's so true. And it's so easy to open up an account, my smartphone. I do investing. Yeah. I've got, I have a couple of brokerage firms. I invest in, crypto technology, and there's other things that I'm invested in as well. And, majority of them I can access from my phone. Usually I'm using my computer because of there's certain things that are just easier to use on a bigger screen than on this. But like you said, the fractional shares, and people are going, what's that mean? It's like, okay, you can't buy, maybe you can't afford to buy one share of Apple. And before I go any further, we're not giving any investment advice on this show. We are not, even though you're licensed, I'm not. So let's not tell people to do this or that. Buy low, sell high. That's about as far as I'm going to go on that.
That's good advice.
But we'll use a different example. You want to buy a stock of ABC company, and that stock right now trades at $642 a share. Okay, well, you're like, well, wow, I only have maybe $300 that I can invest in. Well, there's certain brokerage firms you can buy what is called fractional shares. So you can buy $300 worth of that share. So you're getting make easy math, 0.5. So half of a share. And you're like, well, what's half a share? Well, if that stock rises and goes up to 1,000, 2,000, whatever the case may be, then you're getting a proportion of that, and that's investing. And it boils down to your comfort level too. And this is one piece of, just, I don't want to say advice, but smart things to do. Don't invest more than you can afford to lose. And don't take everything and say, you know what, somebody said this on Twitter, so I'm putting it all in. And even this morning, I'm watching an investment show, and there was a movie chain. I'm not going to mention their name, but their stock has been talked about quite a bit in recent months, and it's gone really high, and now it's dropping like a lead balloon. And there are a lot of people that bought it way up here, and now it's way down here, and they may have just completely blown up their investment account, and they may be so low on that. And that's one of the risks. So I think the takeaway is get an education.
I would say there's a really big difference between this meme stock investing that's happening right now, of this trend of these particular stocks are doing well, versus traditional asset allocation type of investing, meaning matching your investments with where you are. And those are generally three things we're looking at: is what is your time frame? Number one, when do you plan on spending that money? Is this money you need in a year? Then don't invest it. because if you lose money on it, you just lost money that you knew you needed in a year. Do you need this in 7 years out? Well, then you want to start looking at investing. Then the second piece is, how comfortable are you with risk? If you've never invested before, it's not a good decision to buy just one individual company, because you're subject to so much risk. You're subject to whoever's working at the company. What if they cheat or lie about something and we don't know that? What if a CEO is a little wacky and they're going to do something that gets them bad press, and that can happen? You also have industry risk or sector risk. So that was last year. It didn't matter what financials looked like for airline companies or for travel companies. They all got hit because of the pandemic. And then lastly, you have market risk. You're always going to be exposed to market risk no matter what you're investing in. So like the financial crisis, the tech crash, you have where the whole market just comes down. So I would suggest that people look at only exposing themselves to market risk and not picking a specific company, because that is pretty risky. But then the last thing you want to look at is, what does your financial picture look like? Do you have emergency funds? Because if you're investing and you're like, okay, this seems like a good idea, you have an unexpected expense comes up. Well, you don't know, is your portfolio, your investment's going to be down that month, and then now you're selling when you shouldn't have been. So you kind of want to identify your goal for the money, your risk tolerance, your financial situation to determine how risky of an investment should you be in. And I would say buying an individual stock would be the higher echelon of risk when we're looking at normal asset classes, because I would consider cryptocurrency to not even be in that. That would be, even to me, way out on the risk scale. And that I would say only put in what you could afford to lose, but maybe take a different approach if it's a mutual fund that has stock exposure, bond exposure, and they're kind of doing that for you, that you can't afford to take on that risk because it's been time tested.
And also, those people that are running those particular funds, their goal, of course, is to make money off of the investments as well. So they are properly trained, educated. They know market conditions and all of that, and it's the risk thing is a huge thing that a lot of people for some reason ignore. They just go, you know what, it's gonna, we hear the phrase, it's going to the moon. Okay, great. Well, does it, or is it going to crash, like a boulder type of situation? And again, a lot of people investing, especially in the early days, they're like, okay, I buy this. Oh, wow, it's up $5. Great. That's awesome. But it can go down $10 tomorrow, especially with the wild swings that we see in some of these things. And again, figuring out what your risk level is, what you're comfortable, because investment, there's risk. There's risk in everything. We don't see it anymore. Go ahead.
Fund managers that are, let's say, following a 60% stock exposure, 40% bond exposure, they're held to a totally different standard because they can only take on a certain amount of risk, where you're not going to see these huge wild swings you would see if you're owning a particular company, because that is really, right, the market's always forward looking. So when we're hearing news that, let's say Apple's new phone that came out was a bust and now nobody likes it, their share price is going to get hurt for a little bit and then kind of fiddle around. But when you're investing in a diversified mutual fund, you aren't necessarily going to see your accounts drop because of one company. So keep that in mind, that you can shelter from risk. And then if you want to buy individual stocks, I would look to do that with maybe 5 to 10% of the money that you have to invest, to say, because it is fun to participate, right? If you enjoy, let's say you shop at the same place all the time and you're like, well, I might as well own some of this company stock. That's a great idea, but you're not risking your whole financial livelihood on this one company doing well. But it is also fun to participate in that, because you feel like an owner of that company when it's like that. So I err on the side of keeping that between 5 and 10% of your overall investment. So it's not going to break you, but it is fun to participate.
I love that. I do something similar to that in the area that I'm in Toronto. The malls have been closed because of the pandemic for a while. They've opened up and then they had to close again because the cases were skyrocketing. But they've reopened, and walked through the local mall that's close to me. And I was walking around. I had a couple places I was going to, but I thought, you know what, let me walk around, because of course there was capacity limits in all of the stores.
Oh yeah.
So I made note of the stores that had long lines. I'm like, okay, and just, observed, okay, what type of store were they, and why they would have a long line. And made a note of it. I grabbed my phone and just made a note of those companies, because those will be ones that I would watch, and create a watch list of, say, okay, let's see how these stores are performing over a period of time. And then when they report their quarterly earnings for the last quarter, it's like, I anticipate if this is the norm across the board, then, they probably are going to do quite well. So again, it's, for me, that's kind of the investigative look into it type of thing. But I agree with you.
You're taking a page out of a book of a very famous portfolio manager, and he was like, do it for the holidays, go around, see the busiest stores, and that's where he would invest his money. So you're basically doing it at the highest level. So that's awesome, and it's fun to do that. Exactly.
And then of course, some of the stores are, they sell things that, clothes that I would never wear, because I'm not in their demographic. They're going after a younger demographic, which is great because it's a huge population. And by all means, as an investor, I'd say, go to where they are, and they're doing quite well. And my daughter actually works for one of those organizations, cool. So in huge line up there. So it's like, okay, well, I know they're doing well, but it's like, please don't tell me what they're doing sales wise. Don't tell me. If you do, then I immediately have to stop what I'm doing. I can't buy that stock. So I won't do that. No, I don't want to get in trouble. But she wouldn't pay attention to it anyway. But ultimately it boils down to, and we keep going back to this theme, is, learn about investing. Yeah. And, there's a bazillion investing, books and resources and people and things like that. But, do your due diligence and seek people out, and people that are in the industry. Nothing against your neighbor or an uncle or things like that. You can listen to them, but do your own research.
Yeah, it's really interesting, these kind of water cooler talks that you have with your neighbors. And because I've been in this business for 15 years, I have had a lot of neighbors come and chat with me about investing, and they often lead with their wins about what they're doing really great. And a lot of times it's not based on hard data, right? It's just like, oh, I heard this was good and I'm buying it. And then they would always kind of tell me these great stories, and I would kind of keep a mental note of what they're investing in. And then when I would see a big dip in that area, or let's say it would kind of go the wrong way, you don't see those neighbors. They don't come out and talk to you, but then when they're buying something else, they'll come out. So just keep in mind too, that people are going to be way less inclined to share with you when they've made a mistake, but kind of toot their horns when they're doing well. So keep that in mind too, that you might not always be seeing the full picture when it comes to investing. And I wrote my book, Investing is Your Superpower, to give you a guide. And I break it down into 3 different phases of creating your own investment strategy. So I'm not really vague in the book. I'm very clear on what you need to do, what steps you need to take, and how to do it. And it's a great place to start, because I wrote it for people that might be like, all right, I'm doing a couple of the right things, I'm saving some money, but I'm not actually investing. How do I go and do that? And I give you a step-by-step doing that. And that's really just learning, because I look at, eventually at some point, we want to stop working. We might want to work because we enjoy it, but not feeling like we have to work because we need to drive an income later on. So if you have to turn this money that you're saving into income, that's a totally different ballgame of investing. That is completely different. You have to learn even more about how to turn your investments into income. So I look at this time right now as you're trying to build your assets and accumulate the wealth as kind of a testing ground. This is kind of boot camp for retirement. Let me get more familiar with how the markets work. Let me get familiar. Let me partner with a company that I enjoy. Do I want to work with a financial advisor? What does this look like? And kind of use this as your quest to really be prepared for in the future. So when you go to make a decision, you're not making the wrong decision when your prime working years are behind you. If you make a mistake now, you learn from it. you can pick yourself up and you can learn from it. If you're retiring and you make a big mistake with your investments, that's it. It can be really scary. So this is just a great time to explore, be inquisitive, and just never invest in something you don't understand. If you don't understand it, ask a follow-up question. Just keep kind of probing until you feel comfortable that you could turn around and explain it to your neighbor. And just, that's when you start to feel like, okay, I'm making this decision because I feel confident, I feel empowered with the information that I learned, and then you're kind of reaching the next level. And I kind of look at it like learning another language. And if I were to pick up a book, or you could used to be able to buy those CDs, put them in the car. And if I'm trying to learn French, I'm not going to become fluent in a couple of months just poking around on a couple different articles. So, you might learn how to order dinner. And you're like, okay, I can say thank you and hello and goodbye. And you just kind of build on these skills. That's the same thing with investing. You don't have to be an expert to get started. You kind of just learn more and more along the way, but you have to be participating in order to get that experience.
Yeah, and when the market goes down, you never see your neighbors because their stock's probably down, unless they know how to short stocks and all that stuff, which we're not going to get into that type of conversation today. But there's I think the key thing is, and there was an investment guy that I know. He gave me a lesson. And he just kind of said the same thing. It's like, okay, you had a loss. Okay, why? What happened? What was the indicator? Was the volume bad on the stock? Was there bad news, or there's a billion factors that can be thrown into it to see why you may have lost. And sometimes I've seen a case where they thought the stock was going to go up to a certain thing, so they held on to it, and then of course the stock dropped, and they went from being profitable on that particular transaction to a losing position.
Yeah, and it's really hard to shave off earnings, right? Even my role as a financial advisor, if a client was coming in and we were looking at their investments and I'm saying, okay, all your winners, let's sell some of them and let's buy more of these losers, they'd be like, I'm going to go. I'm going to come back next month when you have better ideas, because it's so unnatural to want to sell your winners. But that's what you have to do in order to keep that money in your pocket, because otherwise it's not realized. You're just looking at it on a statement. So you're hitting on all the points. Our behaviors and emotions really dictate how we invest, which is why you'll get better with more experience.
Exactly. And I think your book is quite powerful in guiding people from that, I don't know what I'm doing, to, okay, I'm starting to get comfortable with it. Never stop learning. And I'm sure, in your 15 years plus of investing, you learn stuff every day. Like, well, I haven't seen that pattern happen too often, or okay, what happened there? Or you think, okay, they announced this, okay, 99% of the time I've seen it do this, and all of a sudden it does something completely different. Why in the world's that? It's like, well, there's so many different factors now that are involved with that throws things off. So I've loved our conversation today. I can't imagine why time goes by so fast, but it did. So where can people find out more about you, your book, and all the awesome work you're doing?
Yeah, you can go to www.empoweredplanning.com and you can download the first free chapter of the book, kind of get a taste of what my style is. If it's something that you're interested in, then you can go ahead and purchase the book. And I hang out a lot on Instagram. I make free educational videos based on questions that I get from people. So check that out, and I would love to hear from you.
It's awesome, and I'll definitely have that information in the show notes. So thank you again for being on the show and for all the amazing work you've done and for the book. I know it's going to help a ton of people become not only investors, but better investors as well, which it benefits all of us.
Thanks for listening to the Breakfast Leadership Show, part of the Breakfast Leadership Network. Visit breakfastleadership.com for tips on empowering your business and your life.